Did you know that a country can go bankrupt just like a company? Yes, although it sounds incredible, entire nations like Argentina, Greece, and even Iceland have experienced what is known as sovereign default. What does it mean? How can it happen? And most importantly, could it happen to your country? Today I'm going to explain it to you in such a clear way that you'll never see economic news the same way again. Today you will discover why a country can go bankrupt, real-life cases from countries that have already experienced it, what happens to ordinary people when this happens, and whether your country could be at risk. What does it mean for a country to go bankrupt? Comparison with companies. A company goes bankrupt when it cannot pay its debts. A country, even as it prints money, also borrows internationally from other countries, the IMF, and private investors. If it reaches a point where it can't repay what it owes or even pay the interest, it enters into sovereign default. It's like borrowing to pay off your mortgage, then borrowing again to pay off the previous one, until you reach a point where no one else will trust you with the loan. That happens to countries, but on a big scale. Historical examples of bankrupt countries: Argentina 2001 and 2020. It defaulted several times. In 2001, people couldn't withdraw their money from the bank, Corralito. Massive protests. The result? Skyrocketing poverty and brutal inflation. In 2020, it restructured its debt again because it couldn't pay. Greece, 2008-2015. The Great Financial Crisis. Greece couldn't pay its debt. The European Union had to bail it out. The consequences: massive cuts in wages, pensions, and hospitals. Massive emigration of young people. Iceland, 2008. Its banks grew too large and collapsed. The entire country nearly went bankrupt. Interestingly, it let the banks fail and imprisoned bankers. It recovered faster than others. Other striking cases: Russia, 1998, Mexico, 1994, Venezuela present. Highlight: history shows that countries can go bankrupt, and it happens more than you think. What happens when a country goes bankrupt? Inflation or hyperinflation, your salary is worth less and less. Banks close or restrict access to money. Tax increases and cuts in public services. Loss of international confidence. The country becomes financially isolated. Visual example, clear metaphor. Imagine your country is like a family living on borrowed time. One day, no one wants to lend them anymore. That family has to cut back. Less food, less electricity, less education. The same thing happens nationwide, but multiplied by millions of people. Can it happen to your country? Warning signs: very high public debt, government spending more than they earn, dependence on external loans, high and rising inflation, distrust among international investors. Comparative example: Japan has a huge debt, but most of it is domestic, and people still have confidence. In contrast, in countries with weak institutions, confidence disappears quickly. What can countries do to avoid bankruptcy? Economic reforms, spending less than income, diversifying the economy, maintaining strong and transparent institutions, negotiating with creditors before defaulting. Final reflection: a country's economy isn't just a numbers game. Behind every national bankruptcy, millions of families lose their savings, jobs, and hopes. Understanding this is key to avoiding repeating the same mistakes. So the next time you hear your government increasing its debt, remember, a country can also go bankrupt, and you will be the first to feel it. Now it's your turn. Do you think your country is at risk of bankruptcy? Let me know in the comments, and don't forget to subscribe to discover more economic secrets explained simply and clearly.